You have spent the last 30 years playing by a specific set of rules. You were told that if you worked hard, lived within your means, and kept your money in safe places, the system would protect you. You watched the market volatility of 2008 and 2020 from the sidelines, or perhaps you endured it, only to decide that cash, certificates of deposit, and treasury bonds were the only true anchors for a person approaching their 50s or 60s. You were told that stability was the goal. But as we move into the reality of 2026, those anchors are starting to drag. What worked for your parents' generation, a world where a bank account paid a modest but real return, has been replaced by a sophisticated mathematical trap. Today, we are witnessing the great devaluation of 2026. It is a silent war being waged against your safe money, and unless you understand the macroeconomic forces at play, you are going to be the one funding the government's debt through the erosion of your own purchasing power. To understand why your cash is dying, we have to look at the sheer scale of the national debt. As of early 2026, the United States national debt has surged past $35 trillion. This is a number so large it becomes abstract, but for the person between 40 and 60, it is incredibly concrete. The interest payments on this debt have now surpassed $1 trillion annually, exceeding the national defense budget for the first time in history. This creates a desperate situation for Washington. They cannot tax their way out of $35 trillion without causing a total economic collapse, and they cannot cut spending enough to make a dent in the principal. So they have turned to the only historical tool left in the box: financial repression. Financial repression is a term that most mainstream financial news outlets will never use on air, but it is the primary strategy for managing the 2026 economy. In its simplest form, it is a policy where the government and the central bank work together to keep interest rates artificially lower than the real rate of inflation. For a government with massive debt, this is a miracle cure. It allows them to pay back their old debts with cheaper dollars that have less purchasing power. But for you, the saver, it is a catastrophe. If your high-yield savings account or your CD is paying you 4.5%, you feel like you are winning. You see the numbers in your account going up every month. But if the real-world inflation for the things you actually buy, healthcare, insurance, property taxes, and quality food, is running at 6%, you aren't gaining 4.5%. You are losing 1.5% of your wealth every single year. You are being taxed on the growth of an account that is actually shrinking in real terms. This is the invisible tax of 2026. If you have $100,000 in a safe account and you lose 1.5% of its purchasing power annually, you haven't just lost $1,500. You have lost the freedom that money was supposed to buy. For the 40 to 60-year-old demographic, this is particularly dangerous because you are in the sandwich generation. You are likely helping your parents, who are already struggling with the 2026 Social Security trap, where their 2.8% COLA increase is being entirely consumed by a 9.7% jump in Medicare Part B premiums. You are seeing firsthand how the system adjusts benefits while the real cost of living explodes. You are watching your parents' safe money disappear into the abyss of healthcare costs, and yet, you are often making the same mistakes with your own cash reserves. The psychology of safe money is what the government counts on. They know that as you get older, your risk tolerance drops. They know you want to see a stable balance in your bank app every morning. They are counting on your fear of the stock market to keep your capital locked in the very instruments they are devaluing. Every dollar you keep in a standard savings account is a dollar that the government is effectively borrowing from you at a discount to pay for their $35 trillion debt. You are the lender, and they are the borrower who has decided they don't want to pay you back in full. They will pay you back in nominal dollars, yes, but those dollars will buy far less than they did when you earned them. Think about the cost of staying alive in 2026. We've already seen that Medicare Part B premiums have moved from $185 to approximately $203. That is a nearly 10% increase in a single year. If your safe money is only returning 4.5%, you are falling behind the healthcare curve by 5% a year. This is not a theoretical problem for the future, it is a cash flow problem for today. For the 55-year-old planning to retire in 10 years, this erosion is a death sentence for your retirement dreams. If you lose 1.5% to 2% of your purchasing power every year for the next decade, you will enter retirement with 20% less wealth than you think you have. You will be forced to make choices you never thought you'd have to make, moving to a smaller home, cutting back on travel, or worse, returning to the workforce in your 70s. The Great Devaluation of 2026 is also being fueled by the sunset of the tax laws. As we move through this year, the Tax Cuts and Jobs Act is expiring, and the tax brackets are shifting upward. Your 22% bracket is becoming 25%, and your 24% bracket is becoming 28%. This means that even the measly 4.5% interest you are earning on your safe money is being taxed at a higher rate. After the IRS takes its cut of your nominal gains, your real-world return isn't just negative, it's deep in the red. You are paying the government for the privilege of letting them devalue your currency. It is a brilliant system if you are the one in debt, but it is a prison for the person trying to save for their future. We have to ask why the official inflation numbers always seem so much lower than what we experience at the grocery store or the doctor's office. The answer lies in the way the Consumer Price Index is calculated. It uses a series of substitutions and hedonic adjustments that don't reflect the reality of a person in their 50s. The CPIW, which is used to calculate your Social Security COLA, is based on the spending habits of urban wage earners, younger people who spend a higher percentage of their income on technology and apparel, things that tend to go down in price. It does not weigh the 9.7% increase in Medicare premiums or the rising cost of long-term care with enough significance. You are being told that inflation is 2.8% because that's the number the government can afford to pay out in benefits, but the inflation you feel is 6% or 7%. That gap is the devaluation zone, and it is where your retirement goes to die. The national debt is the elephant in the room that no one in Washington wants to address because the solutions are too painful. To truly fix a $35 trillion debt, the government would have to cut Social Security, cut Medicare, and raise taxes to levels that would trigger a revolution. Instead, they choose the path of least resistance: inflation. Inflation is a hidden tax that doesn't require a vote in Congress. It is a slow, steady theft that most people don't notice until it's too late. By the time the average American realizes that their $100,000 only buys $60,000 worth of goods, the debt has been managed and the wealth has been transferred. For the person between 40 and 60, the realization must be this: cash is no longer a safe asset. It is a speculative bet on the integrity of a government that is $35 trillion in the hole. When you hold cash, you are betting that the government will value your savings more than its own survival. History tells us that this is a losing bet every single time. From ancient Rome to modern-day Argentina, when a state becomes this burdened by debt, it always chooses to devalue the currency. The United States is not exempt from the laws of mathematics. 2026 is the year where the bill for decades of overspending is being presented, and the safe saver is the one being asked to pay it. So, what is the role of the Macro Sentinel in this environment? Our role is to recognize the battlefield for what it is. We must stop thinking in terms of nominal returns and start thinking in terms of real returns. If an investment doesn't beat the real rate of inflation plus your marginal tax rate, it is a liability, not an asset. This requires a fundamental shift in how we view risk. In 2026, the greatest risk is not the volatility of the stock market. It is the certainty of the savings account. The person who holds too much cash because they are afraid of a 10% market correction is missing the fact that they are experiencing a guaranteed 20% correction in their purchasing power over the next few years through devaluation. We must look at assets that have intrinsic value, assets that the government cannot print more of. This is why we see a renewed interest in commodities, in real estate, and in companies with massive pricing power. If a company can raise its prices at the same rate as inflation, its earnings will maintain their value in real terms. If you own a piece of property, its value will generally rise with the devaluation of the currency. But if you own a digital entry in a bank ledger that pays a fixed 4.5% interest, you are standing still while the tide is coming in. The great devaluation of 2026 is also a social crisis. It is creating a wider gap between those who own assets and those who own cash. For the 40 to 60-year-old who is just now starting to save seriously, the hurdle has become much higher. You are running up a down escalator that is accelerating. To reach your goals, you have to be more aggressive, more informed, and more tactical than the generation that came before you. You cannot afford to be a passive investor. You cannot afford to trust the safe labels on financial products. You must be your own sentinel. We must also consider the international perspective. The dollar is the world's reserve currency, which has given us a get-out-of-jail-free card for a long time. But in 2026, the world is watching our debt levels with increasing concern. As other nations begin to diversify away from the dollar, the demand for our currency drops, which only accelerates the devaluation at home. When the rest of the world stops wanting to fund our $35 trillion debt, the government will be forced to print even more money to cover the interest, creating a feedback loop of inflation that will hit the American saver the hardest. This is the macro environment of 2026. It is an era of high debt, high interest expenses, and a desperate government. It is an era where the safe rules of the past have become the trap rules of the present. The 2.8% COLA for Social Security is a perfect example of this misdirection. It is a token gesture designed to keep the population from noticing that their real wealth is being siphoned away through Medicare hikes and tax sunsetting. If you are 50 years old, you have roughly 15 years of peak earning power left. You cannot afford to waste a single one of those years holding assets that are being targeted for devaluation. You have worked too hard for your money to let it be used as a sponge for national debt. You have spent decades in the workforce, navigated multiple recessions, and built a life for your family. The 2026 devaluation is the final boss of your financial journey. It is the challenge that will determine whether your retirement is spent in comfort or in a constant struggle to keep up with rising costs. The system is betting on your silence and your lack of mathematical awareness. They are betting that you will see the 4.5% yield and feel safe while they take 6% of your purchasing power through the back door. But the Macro Sentinel sees the back door. We see the $35 trillion debt. We see the interest payments that exceed the military budget. We see the Medicare premiums that outpace Social Security increases. And we see the tax brackets that are about to reset on a generation that isn't ready. Awareness is the first step of defense. Once you realize that the safe path is actually the most dangerous one, you can begin to take the necessary steps to protect your perimeter. You can begin to move your capital into vehicles that provide a real return, that offer tax efficiency, and that have the ability to grow along with inflation rather than being buried by it. As we move forward, we will explore the specific strategies for fighting this devaluation. We will look at how to use the $24,500 401k limits to your advantage and why the $11,250 super catch-up for ages 60-63 is a vital tool for those in the final sprint. We will look at the role of inflation-protected securities and why the old 60-40 portfolio is being replaced by more dynamic models that account for the 2026 reality. We will look at how to protect your safe money by redefining what safety actually means in a world of $35 trillion in debt. The era of passive saving is over. The era of the strategic sentinel has begun. You have the data, you have the context, and you have the power to change your trajectory. Don't let the great devaluation of 2026 be the moment your retirement story ends in a whimper. Let it be the moment you took a stand for your wealth, for your family, and for your future. The government is playing a game of survival, and they are using your savings as their chips. It's time to take your chips off the table and play a different game. A game where you are the one in control. Stay analytical, stay preventive, and stay tuned. We are only just beginning to pull back the curtain on the macro realities of this year. This is Macro Sentinel. We are standing watch, and we will not let your hard-earned wealth be devalued without a fight. Look at the history of the 1970s if you want a roadmap for where we are headed. That was the last time we saw this kind of structural inflation and debt pressure. The people who stayed in safe bank accounts lost half of their purchasing power in a decade. The people who owned assets, real estate, commodities, and high-quality businesses not only survived, they thrived. 2026 is shaping up to be the 1970s on steroids because our debt levels are so much higher now than they were then. We don't have the same margin for error. We don't have the same industrial base. We only have our wits and our ability to move faster than the bureaucracy. The 2026 Social Security trap and the tax sunset are just the opening salvos of this campaign. They are testing the waters to see how much the American public will tolerate. If we accept a 2.8% increase while our costs go up by 10%, we are signaling that we are willing to be devalued. We are signaling that we don't understand the math. But the Macro Sentinel audience is different. You are the ones who look at the fine print. You are the ones who ask why the Medicare premium is jumping to $203 while the raise is only $56. You are the ones who realize that the $24,500 contribution limit is only a benefit if the tax rates don't jump to 28% when you take the money out. This is a call to action for the sandwich generation. You are the most important financial demographic in the country. You are the ones holding the wealth, managing the families, and planning the future. If you fall for the great devaluation, the entire economic structure of the American family is at risk. But if you stand firm, if you educate yourself, and if you act with precision, you can turn this crisis into an opportunity. You can build a fortress that no amount of government debt can knock down. You can ensure that your parents are cared for, your children are launched, and your retirement is secure. The $35 trillion debt is not your fault, but it is your problem. Washington will not fix it for you. The big banks will not fix it for you. They are all part of the same system that benefits from your devaluation. You are the only one who can protect your safe money. It starts with moving away from the nominal mindset and adopting the real mindset. It starts with questioning every safe label you see. And it starts with the realization that in 2026, the only truly safe asset is an informed and vigilant mind. We are entering a period of unprecedented economic experimentation. Never before has a global reserve currency been this burdened by debt, while simultaneously trying to devalue its way out of it. There is no textbook for what happens next, but there are historical precedents that show us the way. The Sentinel looks at those precedents, combines them with the real-time data of 2026, and builds a strategy for survival. We will continue to provide the analysis you need to navigate the Medicare hikes, the tax sunsets, and the inflationary traps. We will be your eyes and ears in a world that is designed to keep you in the dark. Don't let your safe money be the fuel for someone else's fire. Don't let your 30 years of hard work be erased by a bureaucrat's pen or a central bank's printing press. The great devaluation of 2026 is a test of your character and your intelligence. It is a test of whether you are a passive victim of history or an active participant in your own destiny. You have the tools, you have the community, and you have the Macro Sentinel. Let's make sure that when we look back on 2026, we don't see it as the year we lost our wealth, but as the year we learned how to truly protect it. Stay sharp, stay focused, and above all, stay vigilant. The war on your money is real, but it is a war you can win if you choose to fight it with data and discipline. We will be here with you, every step of the way, making sure the math adds up in your favor. This is our mission. This is our promise. Let's get to work.